Welcome back to the deep dive. If you're an investor in property markets, you already know the reality. Capital efficiency is, well, it's everything.
It absolutely is.
And when a time-sensitive opportunity pops up, a motivated seller, a great off-market deal, the slow, methodical path of a traditional bank loan.
It's a death sentence for the deal. That's the whole problem right there.
Exactly.
You just can't secure competitive deals if your funding timeline is, measured in weeks or even months. So the mission for this deep dive, based on the sources we have, is to really understand the machine built to solve this.
Hard money lending.
Specialized non-traditional real estate financing.
Yeah.
Hard money.
So our target today is to get right into the operations of a San Diego-based source. We're going to give you a shortcut to understanding how serious investors get liquid and closed deals at speeds that, frankly, traditional lenders can't even imagine.
And our sources establish the philosophy behind it right away. This isn't just an alternative to a bank. It's a completely different way of assessing risk.
Okay, so let's unpack this immediately. If a traditional bank is looking at my debt to income, my W-2s, my credit score, what's the fundamental shift in thinking that lets a hard money lender, HML, move so fast?
The shift is, well, it's entirely away from your personal financial history.
Away from the person.
And completely toward the strength of the collateral. It's property-centric lending. So while a bank looks at you, your past earnings, your reliability,
all my paperwork.
All your paperwork, and HML primarily looks at the property.
So the aha moment here isn't that they're skipping due diligence. It's that they're just prioritizing a totally different set of metrics.
Precisely. They are laser-focused on two things: the current value of that property and, critically, its future profit potential.
Okay, so that means the key metrics aren't things like my personal DTI.
No, not at all. They're looking at the property's loan-to-value, the LTV, and for something like a fix and flip, the loan-to-after-repair value, the ARV.
That's where it gets technical, which is good. Explain that difference. How does that ARV ratio give them their speed advantage?
LTV is pretty straightforward, right? It's what percentage of the current purchase price are they lending you? Maybe 70% LTV.
Got it.
But for an investment property, especially a distressed one, the future value, the ARV, is the real security for the loan. If they structure the loan based on that future value, then they are essentially underwriting the success of your project.
So they're funding the vision, not just the current state of the house.
That's a great way to put it. And it means they can often fund not just the purchase, but sometimes 100% of the renovation costs needed to hit that higher value.
And that focus on the asset, on the collateral, is what cuts the timeline down to just days. They can skip that whole process of verifying 3 years of tax returns.
That's the key.
I mean, the source makes a huge deal of this. Approval and funding in a streamlined 10 to 14 days.
And that rapid closing is the product. That's what they're selling. In a market where cash is king, the difference between 2 weeks and 2 months is the difference between getting the deal and losing it.
But let's be clear, there's a trade-off.
Of course. That speed and flexibility comes at a premium. The lender is taking on more risk, basing their decision on future potential rather than your documented history, so that means higher interest rates and fees.
That's the critical point. So if the main criteria is just the property, what stops a new investor from, biting off more than they can chew? Especially with the higher costs.
The LTV and ARV ratios are the guardrails. HMLs are almost never lending 100% of the purchase price.
They need you to have skin in the game.
Exactly. By requiring the investor to put down, say, 25 to 30% of the initial purchase, the HML makes sure the borrower is motivated to actually finish the project. It mitigates their risk. The deal has to make sense even at a higher interest rate for it to work.
Okay, that makes sense. Let's pivot to the toolkit then. If their model is based on how the property will be used, they must have different products for different strategies.
Absolutely. You should think of these less as simple loans and more as strategic financial tools. Each one solves a very specific problem that a traditional bank just can't or won't touch.
Let's start with the fast action stuff. The loans for the flippers and the builders.
The fix and flip loan is the classic. It's their signature product. It's fast funding, structured to cover both the acquisition and the construction budget for the renovation. It's built for quick turnover.
And for the developers, the people actually adding new housing stock.
That's where you see the ground-up construction loans. This kind of financing has to be highly flexible, right? It's tailored for new builds. Traditional lenders get very nervous about construction loans.
All the moving parts, the inspections, the disbursements.
Right. And HML builds their whole process around managing that complexity. And then for investors looking to scale their rental income, you have multifamily loans for things like duplexes, triplexes, up to larger apartment buildings.
Okay, now let's get into the really interesting niche loans, the ones that solve the timing and barrier issues with banks. The bridge loan seems like the classic example.
A bridge loan is. It's a crucial short-term tool. It's all about bridging a capital gap. So, for example, an investor can use a bridge loan to snap up a new property while they're waiting for their existing property to sell.
Or while they're waiting for slower permanent financing to get approved.
Exactly. It stops a great deal from falling apart just because the timing is a little off.
But the products that really caught my eye are the ones that address the structural problems that entrepreneurs have with big banks. Let's talk about the DSCR loan. This feels like the gold standard for anyone's serious about a rental portfolio.
Oh, it's a total game changer. DSCR stands for Debt Service Coverage Ratio.
Right.
And this is where HMLs just operate on a different planet from banks. Instead of looking at your personal income, your personal DTI, which of course limits how many mortgages you can hold.
Which is the ceiling for every investor trying to scale.
It's the ceiling. The DSCR loan bases its decision purely on the cash flow generated by the property itself. If the rent coming in can adequately cover the mortgage and other costs, the loan qualifies.
Which means an investor can, theoretically, scale almost infinitely.
In theory, yes. Your personal debt history starts to become irrelevant. Each property stands on its own as a financial entity. So as long as your properties are cash flowing, you can keep adding more to the portfolio. That's how the pros build massive portfolios.
And the last one here addresses a huge part of the modern economy, the bank statement loan.
This targets a massive, and I mean massively underserved group of people, the self-employed business owner, the high-earning freelancer.
People with great cash flow but messy tax returns.
Precisely. They have amazing cash flow, but they use sophisticated tax strategies. They write off expenses, which results in a low net taxable income, and that's the number banks care about.
Right.
A bank statement loan just bypasses that. It looks at the actual cash deposits going into their business or personal bank accounts over, say, 12 or 24 months. It's a direct solution for the banking system's failure to understand how entrepreneurs actually earn money.
That toolkit really lays out the competitive advantage. But now let's shift to location. The source says they are not just another lender, we're your partner. That suggests that in a market like San Diego, the where is just as important as the what.
The local knowledge part is non-negotiable. It's critical.
Ugh.
A big national lender can plug LTV numbers into a spreadsheet, sure, but they can't possibly assess the granularly street-level risk and opportunity you find in a place like San Diego County.
Okay, so give me a tangible example. How does that local knowledge lead to better underwriting? What does a local lender see that a remote one would miss?
Okay, think about the regulatory environment. San Diego is notoriously complex.
Especially near the coast.
Especially near the coast. A local partner understands which specific areas, like, say, Oceanside versus downtown San Diego, have different permitting backlogs that can add 3, maybe 6 months to your project timeline. That's a huge cost.
And a national lender would have no idea.
No idea. They'd also know that in certain parts of Chula Vista, land values are jumping because of specific infrastructure projects, while other areas might have coastal commission rules that dramatically limit what you can even do with a renovation.
So they're not just providing money, they're providing embedded risk intelligence about all these little micro markets inside the county.
That's it, exactly. They understand local property values, not as a big number, but neighborhood by neighborhood. And that detailed knowledge leads to much more accurate ARV assessments.
Which lets them be faster and more flexible.
Yes, because they trust their own valuation models. They know the unique challenges of buying in Escondido versus, coastal La Jolla. It's not the same thing.
And that local focus is how they actually help investors secure properties and maximize their profits without the specific headaches of the Southern California market.
Right. And that idea of partnership, of local relationships, that directly leads to the need for transparency. This lending sector can sometimes be seen as a bit opaque.
The hard money name doesn't always help.
It doesn't. So the source really emphasizes clear answers, fair terms, and honesty, which is essential when you're dealing with products that, by nature, have higher interest rates. Investors need to know exactly what that speed is costing them.
So let's pull all these threads together. What does this all mean?
Well, it means that specialized real estate financing is defined by speed, a speed that's achieved by completely shifting the risk assessment away from the borrower's past history.
And onto the property's potential, its future value. It's a strategic tool, not some loan of last resort. It's for everyone, from the seasoned flipper to the person trying to scale a rental portfolio.
And that ability to close in that 10 to 14-day window, it fundamentally changes the competitive landscape for an investor. They're bridging that capital gap. They're letting investors scale using a property's potential, not their personal paycheck.
But that efficiency, as we said, have a price tag. And that brings us to a final provocative thought for you, the listener. The whole hard money model is built on the idea that time is money. The funding leverages the property's potential, the LTV, the ARV, not your credit score.
Hmm.
So this raises a really key strategic question. If speed is the ultimate competitive advantage in a hot, appreciating market like San Diego, how do you calculate the exact premium an investor should be willing to pay through higher rates and fees to make sure they never miss an opportunity? And, maybe more importantly, how does factoring in that higher cost of capital change your very definition of what makes a good deal compared to when you're using traditional, slow, long-term financing? That's something for you to mull over as you build out your own investment strategy.